Hello friends and welcome to the lecture. So students, as we know that we are covering the financial system and basically we are covering the non-banking finance companies, right? Non-banking finance companies. Okay? These are the topics we have scheduled for the discussion in this particular series, like the introduction, okay? Like the credit intermediation, like the asset financing, housing finance, microfinance, investment and the wealth management, infrastructure finance, conclusion. Okay. Out of these, we have covered the introduction part. We were in the discussion of the credit intermediation. Okay. And what we are left with? We are left with the asset financing, housing finance, microfinance, investment and the wealth management, infrastructure finance, conclusion. Okay. So this is the you can say picture we have created so far. All right. I hope that you have revised the previous lecture in the good manner before you have come for this lecture because it is for your own benefit. So let's start. Collateral flexibility we have discussed in the previous lecture. Now we have the credit to the SMEs. Okay. But before starting this, I will ask you a very, very simple question. SME, then M is ME. Okay. So the question is, what is the full form of these two terms? Okay. You have the 15 seconds to think and answer and your time starts now. Just think about it. Okay, the time is going to be up. All right, the time's up. So if we talk about the MSME, then MSME stands for the micro, small and medium enterprises. Micro, small and medium enterprises. Okay. Whereas if we talk about the SME, that stands for small and medium enterprises. Okay. So please keep these definitions in your mind. That will be helpful in your examination. Okay. So after asking the question, let's move to the thing. Small and the medium sized enterprises, also known as the SMEs, often considered the backbone of the economy, sometimes struggle to obtain finance from the traditional banks due to the perceived higher risk and lower profitability of serving such clients. NBFCs tap in to fill this gap by providing SMEs with working capital loans, machinery loans, and other forms of credits. Okay, so basically, when we talk about the traditional banking, right? Traditional banking. So we know that these banks are very famously known for this particular saying, no one is more greedy than bank, right? So basically, if we talk about the scenario, so large scale enterprises, they are in the first choice of the traditional banks. Why? Because they are highly stable, Okay. Second could be a high interest rates. All right. Third could be a loans for short and long terms both. Okay. Whereas when we talk about the SME, okay, so generally the SME are mostly, or you can say not mostly, less stable, okay, could not bear high interest rates, okay, and mostly prefer to obtain loans for long term only. Okay, so this is the series. Okay, so if we think from the perspective of the traditional banks, they generally search the clients which are highly stable. It means that the danger of being the NPA, also you could call it as a non-performing assets, or NPA. Okay, so generally being the conversion into the NPA or the non-performing assets, the factor of highly stable protect the bank's securities. Okay, so they generally find the client which is highly stable so that it could not be turned into the NPA that easily. Okay, thereafter could be a high interest rates so that the bank could earn more profit. Thereafter could bear the loans for short and long terms both. It means that the bank could be benefited by the short term and the long term policies in this manner. All right. Whereas when we look at the SMEs, so they are less stable. It means that they having a good chances of being converted into the NPA. Right. Thereafter, they could not bear the high interest rate. It means the profitability of the banks is less in the SME in comparison with the large scale enterprises. Thereafter, they mostly prefer to obtain loans for the long term only. It means that the bank which will grant the loan to the SME will have to grant a loan for a longer duration, and this could lead to the capital inadequacy because the money which have been granted to the SME will become after long time. All right, not so in the shorter duration. All right, so that's the difference in the LSE and the SME. Okay, so basically you can say to facilitate the SME also, NBFCs step in and they providing SMEs with working capital loans, machinery loans and other forms of credit, which is generally not offered by the traditional banks. Okay, so remember this one. But here one thing also, like, okay, why we consider them as a backbone of the economy. This is the main reason. Like why we consider them as a backbone of economy. I had already told you this thing in the previous lectures, but here I want you to recall it. Okay, so let me give you an explanation. So basically, when we talk about the three basic questions, which we had just discussed in the previous lecture, like what to produce, okay, thereafter whom to produce, all right, and how to produce. These are the three basic questions. Okay, so you can say, suppose there are 100 people, all right, 10, 50, 40. That was the division we had discussed in the previous lecture. All right, these 10 peoples are the rich class, or you can say financially sound. These are the people who having the access to the traditional bankings. Okay, but these are the financially excluded people. Okay, so basically in the answer of what to produce, the NBFC has finalized XYZ. Like they will produce the XYZ. For whom? For these 40 people, because they will be their potential, or you can say targeted clients. All right. So here we have signified the two main questions, like what to produce, how to, or whom to produce. Only question left with is what to produce, like how the things XYZ could be done. Okay. So here basically there are two technologies or techniques for the production of goods or services, whatever. Okay, like the first in the CIT, then the LIT. Okay, CIT stands for Capital Intensive Technology. Okay, whereas the LIT stands for the Labor Intensive Technology. Okay, so basically this is the two types of technologies. In the capital intensive technology, we use the softwares and hardwares instead of human beings. But in the LIT, we generally prefer the human beings to work, not the hardwares and softwares. Okay, so basically the large industries are capable enough to get this technology known as the CIT, Capital Intensive Technology. They are having the adequate capital to obtain the relative hardware, softwares, all right, for this one. This will reduce their production cost because they are not required to pay the salaries and maintenance and all right, but the initial investment is very, very huge. The other ones means the small and the medium sized industries, they do not having the capacity to meet that particular initial capital. All right, that's why they are highly, you can say, rely on the LIT, and this generates employment in the society. Okay, so this is the thing. All right, what to produce, how to produce, sorry, whom to produce and how to produce. Got it? So how to produce will be depend either on CIT or LIT, depends upon the financial condition of the organization. Okay, after this we have the infrastructure lending. Infrastructure projects require substantial long-term funding, which may not always be forthcoming from traditional banks due to the asset liability mismatches. All right, like you can say, we should read it again. Why? Because there is some kind of technicality. Infrastructure projects require substantial long-term funding, which may not always be forthcoming from traditional banks due to the asset liability mismatches. For example, you can say, suppose this is an XYZ. This is an corporation. Okay. This is ABC. This is a bank. Okay. There are two cities. City 1, City 2. Okay. The distance between them is 100 kilometers. Okay. So what happened that XYZ Corporation gets a contract to build this 100 kilometers 4-lane highway. Okay. So basically, if we talk about this one, so what is this? This is an infrastructure. And infrastructure having both the qualities. It means time taking. Second is huge capital. Okay. So if we're talking about this 100 kilometers 4-lane highway, all right. So basically this could not be converted into 1 day, 3 days, 4 days, 1 month, 6 months, whatsoever. At least 2 to 3 years will be the less estimated time for the completion. All right. So it is a time taking. Whereas if we talk about the capital, so minimum to minimum capital investment will be around rupees 18,000 to rupees 20,000 crores. If the highway is to be 1800 to 200 crores. Okay, if the highway is to be maintained on the modern terms. Got it? So here it has become huge capital investment also. Okay, so if we talk about the traditional bank's point of view, I had told you that traditional banks having a several responsibility to discharge, like they are liable for depositors, okay, for regulators, all right, for economy, they are required to maintain the reserves, all right, and various other things. So that's why they are generally not so free in order to invest in the, you can say, in the infrastructure, because they could not lend out this huge amount for this time period. And even there is a risk associated with them. Which means, what if the highway project was withdrawn? What will be the implication of this? So there are so many things. All right. So generally, the traditional banks not enter into infrastructure financing. Infrastructure financing. Okay. However, the infrastructure financing is included in which one? Included in the priority sector lending. Okay, but still it's depend upon the bank that whether the bank is financially sound and capable enough to do this kind of things. If not, the bank could withdraw even after infrastructure falls under the category of priority sector lending. Okay, so here what will happen? The NBFC, which are generally not so obligated and restricted on these terms, means the depositors, regulators, economy and reserves, this comes in the picture, and they generally finances the infrastructure. Okay, because they could, you can say, pay this amount for this year. Okay, so they could bear the both time taking process and you can say the huge capital investment. All right. NBFCs often have more flexible capital structures that can accommodate the long gestation periods of the infrastructure projects. Okay, so you can say because they are, the NBFCs are basically relatively free in comparison with banks. These are relatively free in comparison with the banks. So that's why they have an advantage. And what type of advantage? That they could easily modify or change agreemental terms. All right, because they having the less regulatory restrictions. Okay, they do not having the much more, you can say, the responsibilities which the traditional banks have. All right, so that's why they are relatively free in operations in comparison with the banks. Okay, so they could easily modify or change agreemental terms in relation with time taking and huge capital based infrastructure projects. Got it? Keep this thing in your mind. Financial inclusion. In regions and among populations where access to traditional banking is limited, NBFCs play an important role in providing the financial services, thus promoting the financial inclusion. As we had discussed already in the previous slides, that basically the traditional banks oftenly targeted the high value clients, or you can say they oftenly targeted those persons who could bear their interest, or you can say their high interest loans for the long durations. All right, so generally they not included the segment of the population which is not falls under this category, and that's why that case becomes the financial exclusion. Okay, but to provide them the facilities, to provide them the things, the NBFC comes in the picture and plays an important role in providing the financial services, thus promoting the financial inclusion. Okay, and even the basic reason for this, which we had discussed in the previous lectures also, known as not having bank account, right? Like we had discussed, generally if someone wants to take the loan from any bank, suppose XYZ, so the person, or you can say he or she, is required to having the account in this particular bank. All right, if the account is not in that bank, then there might be some, you can say, challenges which could be arised. Okay, this is particularly critical in emerging economies where a significant portion of the population may be unbanked, because the significant portion of the population is not capable to maintain the average maintain balance, also known as AMB. Okay, thereafter bear high interest rates. Okay, and you can say must open multiple bank accounts into many banks. Okay. So these are some of the reasons why the large population of India is unbanked, or you can say underbanked. Thereafter, the risk management. While extending credit to undeserved segments, this could be riskier. So that's why the NBFCs employ the sophisticated risk management frameworks to mitigate the potential defaults. Like they diversify their credit portfolios across various sectors and customer segments. For example, you can say, suppose if this is NBFC, okay, they having 40 lakhs amount available for them for the loan granting. So they could have two choices: agriculture, 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 and agriculture. First choice. Second choice. Agriculture. Okay. Industry. All right. Education. Okay. And you can say solar power. So what you are seeing here, this is the landing into the one sector only. Okay. This is the diversification. Okay. So NBFCs will diversify this amount into these areas. So even if one sector defaulted, the others will be functioning as normal. Okay. So that's how the system works. So students, basically we have finished till the risk management in the credit intermediation in the lecture of the NBFC. We will continue from here in the next lecture. Till then, just remember all the facts and figures we have discussed in this lecture. Be ready for another lecture. With this note, let's end this lecture, and what we say thank you.